There are opportunities out there, and you know us. On this show, we're always looking for the silver lining. We're looking for the opportunity. You can either complain about the way things are and allow that to dictate your life, or you can look for the opportunities. And that's what millionaires do. So, today we want to share with you 5 ways that you can use higher interest rates to your advantage. And the first one is probably the most basic one, and you've probably noticed it already, and that is better rates on savings accounts and other kinds of accounts at your bank or credit union. So we're starting to see rates for basic savings accounts go up. We're certainly starting to see increased rates on money market accounts and even CDs. You know, I've talked to many clients that they're looking for CDs or a credit. That's a certificate of deposit is what it's called at a bank. At a credit union, it's going to be called a share certificate. Regardless, it's the same thing. You stick money in there for a certain amount of time, 3 months, 6 months, 12 months, 18 months, a few years, whatever. You pick your term. The longer you keep your money in there, the better rate you're going to get. And for a long time, if you wanted any kind of interest rate at all, 2% or something like that, you had to keep your money in there for 3 years or more. Now we're starting to see short-term CDs that are paying 3, 4%. You got to look for them. But those opportunities are out there. So if you do have a lot of cash sitting in the bank, that's still probably not the best place to put it. That's not the best opportunity, but you at least don't feel so bad about keeping $100,000 or $200,000 in your emergency fund in your money market, because now you're earning a little bit more interest as a result of interest rates going up. So that's at least a good thing. Although if you don't need access to the money immediately, you might consider a CD, a longer-term situation, so that, if you don't need the money for a year or more, maybe look at a CD, get a better interest rate, and then you'll have that liquidity when your need arises sometime later in the future. Now, let's say that you have a chunk of money, some cash, or maybe even some money that's been in the stock market. The market has rebounded pretty significantly here at the beginning of 2023. As of the end of this week, the market was up. It was up over 8% at one point. So that's a pretty nice little rebound. It's still going to continue to be volatile. Don't get fooled that this is all over. The volatility in the market is still going to exist so long as the Federal Reserve threatens to raise interest rates. And we expect them to raise interest rates at least one more time in March. So that volatility is going to be there. So there may be an opportunity here now that you've seen a little bit of an increase. You've rebounded in your investments in the market a little bit. Perhaps an opportunity to pull some of those gains off the table and protect them. So it is now more attractive to protect some of your money in a protected money account, which we offer to our clients. It's all about balance, and there's growth in the market, but you can also protect your money and protect from any kind of loss at all. No loss at all due to market volatility. In fact, we've got access to a protected strategy, a protected money strategy with an A-plus rated company that right now, because interest rates have gone up so much, they are offering a 32% bonus on your income bucket. So let's say, for the sake of argument, that you have $250,000, whether it's cash or it's money in the market, and you want to protect it. You want to protect it from loss, and you want to get more interest potential than if it's just sitting in your money market. So you put $250,000 into this protected money strategy. The bucket that you turn on for income later on, so this is an income bucket. It's designed to provide cash flow to you later on in retirement. If you put $250,000 into this strategy, the bucket that you turn on for income later would instantly grow to $330,000. And that is the bucket of money that you can then turn on for income later on, and you're going to pull out, 4, 5, 6% out of that. But that's only if you turn it on immediately. If you leave it in there for several years, it's going to continue to grow over time. So you're going to get a 32% increase immediately, plus whatever the growth is over time, 6-7%, something like that. And that is a guaranteed income bucket, a guaranteed income stream. We have not seen bonuses like that and earning potential like that in protected money accounts in a long time because interest rates have been so low. Now that they're higher, you can get those kinds of interest rates, those kinds of things. We have other protected money accounts that you can get an instant bonus on the accumulation value, the actual account value. So that's one way. If you've been thinking, I'd really like to protect some of my money, 2022 was a rough year for me in my stock market investments, I'd like to pull some of that money off the table, protect it, or I've got a bunch of cash sitting in the bank doing not as much for me, there are opportunities now to lock in all of your gains, protect it from loss, and get much better interest rates. Here's another option, more income from bonds. Now, many of you, maybe you've been for the longest time, I hate bonds. I don't want to get into bonds. They don't grow as much as stocks, and I've been growth for many, many years. I'm ready to keep it going. However, 2022 was a slap in the face, a dash of cold water poured on you, and now you're closer to retirement. Now you're shifting from accumulation to thinking more of preservation and distribution. You want to dial back a little bit on the amount of risk that you're taking. So maybe it's time to rebalance from leaning more towards riskier stocks to now looking at bonds. Well, for the longest time, bonds were very expensive and their interest rates were terribly low. When interest rates are very low, bond values are high, but the income they pay out's very low. Now we have the opposite situation. We have a situation where interest rates have gone up and bond values have come down. Bonds are a lot cheaper to buy right now than they were even just a year or so ago. And they are still less volatile long term than most stocks. So this could be a great time now to look at investment-grade bonds, which are now producing more income. To get the kind of income that you wanted, you had to go with riskier, high-yield bonds. Now you can get less risky investment-grade bonds, some of the best ratings out there, AAA and AA, things like that. You don't have to go into the junk bond status to find good interest rates. Now you can get a great interest rate in the range of 5, 6, maybe 7%. And then the double bonus is that income is locked in so long as you have that bond later on. If the Federal Reserve decides to lower interest rates again, not only are you going to continue to get that higher interest rate when you bought the bond, but now your bond value is going to go up because there's an inverse relationship between interest rates and bond values. Interest rates go up, bond values go down, but interest rates go down, bond values go up. So this might be a great opportunity, especially if you're looking to transition from growth to income, to take a look at bonds. And if you've got a bunch of cash and you want to create a bond portfolio that's going to pay you some decent income, in addition to looking for bonds for income, we can look for bonds that are tax efficient. Because if you have cash that you just put into the market, that's after-tax money, you're going to get taxed on the income that those bonds create. So maybe there's an opportunity to use tax-efficient bonds like municipal bonds, which are federally tax-exempt. You see, there are so many of these opportunities if you just know where to look. And if you just change the way you think, stop thinking about how everything is out to get you. That's one of my favorite things about this job. I love this job. I love what I do because I look at this as a puzzle. It's a puzzle. And how can we fit the pieces together to benefit you, to benefit our clients? How can we maximize what we're doing? How do we use the rules of the game to end up winners no matter what happens? And that's what I love about this. So, more income from bonds. That's another way. The third way that rising interest rates can help you. If you're just joining us, you're listening to It's All About the Money, Honey, here on News Radio 1000 KTOK. My name is Damon King. I'm a certified financial planner professional and wealth manager with ChappelWood Financial Services, the sponsor of It's All About the Money, Honey. We are investment advisors to millionaires, and today we're sharing with you the same kinds of things that we share with our millionaire clients. And the topic today is 5 ways that you can use rising interest rates to your advantage. We know that over the last year or so, it's been rising interest rates that have caused the market all kinds of anxiety and heartburn. It caused your statements in 2022, every quarter you opened those up, and you're like, oh God, I don't want to do this. And you open it up, and you're like, oh, stab me in the heart. Except for the fourth quarter. Your fourth quarter statement probably looked positive. But first, second, and third quarter of last year, it was a creep show, right? It was not fun to do that or to open those up. Here at the beginning of 2023, the market has rebounded. Things continue on this course. Here we are now in February, and if things continue like this, then you might see a really nice first quarter statement in April. But a lot can happen between now and the end of the first quarter. So don't count on it. All we can count on is what's in front of us right now and how can we use rising interest rates to our advantage. So we've already shared the first 3. You're getting better rates on your savings account at the bank or credit union. It's more attractive to protect some money in a protected money account, which we can help you do. We do that. We use them all the time in conjunction with our riskier stock market investments. In fact, later on, here in just a moment, I'm going to share with you how you can get your own gold bucket optimizer. And right there, 2 of the buckets are guarantee of principal, your protected bucket, and stocks, bonds, and mutual funds. And you plot those, how much you have in each one of those buckets, and you see, what is my percentage of money that's at risk of loss in the market? What is my percentage of money that has no risk of loss? And depending upon those percentages, you may be overweight in one or the other, or maybe you're just right. But you don't know until you take a look at it. So it's more attractive to protect some of your money. We're seeing amazing bonuses on some of these protected money accounts that you can, like I said, put in $250,000, $500,000, and one of them offers a 32% bonus on the bucket of money that you would turn on for income later on in your life as another stream of cash flow. And then the third one so far that we've shared is more income from bonds. Bonds are much more attractive now. The stock market is volatile, so people fly to bonds. And it just so happens that bonds are paying higher interest rates and they're cheaper because rising rates lowers bond values, the cost to buy the bond. So that's kind of a double benefit there. Number 4, this is kind of an interesting one. And I like to include this one because, again, as a millionaire, you're thinking outside the box, and we're helping you think outside the box. Let's say that you have a business that you want to sell, or even a house. You've got a high-end home that you want to sell, and let's say that your home is $500,000 or more, or the business that you want to sell is $1 million or more. And the persons or the people that might buy this asset from you are going to have to finance the sale. They don't have the cash on hand to buy it. So what are they going to do? They're going to have to get a loan of some sort. Now, the most common scenario is they would go to the bank, they would apply for the loan, and then the bank would pay you, and then they would start making payments to the bank. The problem is, right now with interest rates going up, it's much more expensive to get pretty much any kind of loan out there. A mortgage, financing to purchase a business, things like that. So it may be that the market for your business or the market for your home is shrinking because now there are more and more people getting priced out of the market because of rising interest rates. What if, instead of having that potential buyer go to the bank to get financing, what if you provided the financing? What if you created a structured installment sale to this potential buyer for your home or business, and instead of sending them to the bank to get the money to pay you, You created a note of your own, and they paid you directly. You become the bank. Now, what are the downsides to this? Well, in this case, if the bank was getting involved and made the loan, the bank is taking on the risk of not getting paid back. And you get your full amount of money. Now, if you do a seller finance situation where you create an installment sale and someone pays you installments over time, you are now carrying all of that risk, the default risk that someone will not pay you back. That is why, if you're going to do something like this, you absolutely want to do your due diligence. You want to make sure that you run the credit check, you know about their employment, the income that they have, any other debts, things like that, before you enter into this kind of arrangement. But the reason this might be attractive is because you may be willing to offer them a much lower interest rate than they could get at the bank. So if they're going to get 6.5%, 7% from the bank on a home loan, and that's preventing them from actually closing the deal with you, maybe you create an installment sale where you offer them 5%. You are taking on the risk, yes, but you're getting your house sold, and now what have you done? You have created a new income stream for yourself. Or what if it's your business and you sell your business for $1 million and you finance that for them at 4% or something instead of the 6 or 7 that they were going to get at the bank? Now you have a stream of income and you're going to have annual installment payments and you're going to get the interest to go along with it. So that's just another consideration, another way to use, in this case, rising interest rates not to your personal advantage, but you're using the fact that if people are going to have to pay more money to borrow more money from a bank, perhaps you can do an installment sale, do the financing yourself, charge a lower interest rate, and now you become the bank, and you're using the fact that it costs more to get a loan to your advantage. It's a riskier proposition for sure, but it is an opportunity. And all opportunities, all investment opportunities carry risk. There's not a single one of them that doesn't carry risk. There is always a risk, even with a protected money account. There's a risk. There's opportunity costs. When you protect your money, you're protecting it from loss, but you might also be limiting the gain long term. So you always have to measure the pros and cons of any situation. And finally, the fifth way that you can use rising interest rates to your advantage, and it's an obvious one. It's staring at you every quarter, especially over the last year. Remember earlier I said it's very painful getting your statements because you see some negatives there on that statement? That's one way to look at it is, I don't want to open this. You know what another way to look at it is? The stock market is on sale! The stock market is in the discount rack. And I can go and walk in, especially if I've got some cash sitting on the sidelines, and I can now go buy great companies at a discount. Rising interest rates have caused the market to fall. It has caused the market anxiety. The market fell 20% in 2022. It's rebounded quite nicely here at the beginning of the year. However, I don't expect that to last. I expect there to continue to be volatility. We're not out of the woods yet, which means that the market continues to be on sale, certainly from where it was at the beginning of 2022. So rising interest rates depress the stock market, and now stocks, which will recover, they're still good quality companies. Microsoft was a good quality company before the market fell 20%. It's still a good quality company. Dividend-paying stocks especially. Think about this. You can go out and get dividend stocks cheaper, and there's an added bonus. They pay income. And I love income. It's my favorite thing. I love money coming into my bank account. And I love money coming in. I love my assets working for me, generating income for me so I don't have to. So the stock market's on sale, and you can use the fact that interest rates are going up and will probably continue to roil the markets so long as they continue to go up. Use that to your advantage and find opportunities to put cash to work and buy stocks at a cheaper price. This is how millionaires think. What are my opportunities? What are the costs? What are the downsides? But what are my opportunities? That is the mind of a millionaire.